Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's May 2022, and I'm going to be in this video setting out a view on the world economy in the next 18 months, 2 years, based on global money trends. But I want to, and I will be warning about a recession, but what I want to do first of all is to return to what I was talking about last month. Last month I was talking a lot about house prices, and I kind of assumed that we had seen the peak of US house price inflation in the current cycle. I was wrong. The increase in US house prices in February was over 2%, and as you can see from this chart, it's still moving away at the end of the period. So US house price inflation is right up again at these peak numbers of 19-20%. And this implies that the task of bringing the economy under control, getting this inflation out of the system, is still with us for a few quarters. I want just to reflect a bit on these house price developments, because they are very important. House prices being much the most important type of asset for most households in most countries. And the first thing I want to say is that it's very difficult to explain the behavior of US house prices in the last 3 years by appealing to credit, or at least appealing to bank credit. As you can see from this slide, the growth of bank credit in the sense of lending for residential real estate loans was very low, only about 1.5% in the 3 years to February 2022. You've had an increase in house prices of about 42%, a bit over 42%, and an increase in the quantity of money of 45%. And I suggest that's where the correlation lies, that house prices are just the price of one kind of asset. When you get money jumping by 45% in a 3-year period, it's going to put upward pressure on all asset prices. Prices of common stocks, the price of bonds, the price of all sorts of things, and houses are going to be affected as well. Now, this then leads on to a very important point about the current debate on current inflation. The common view at the moment, standard view, certainly the kind of view being put out by the central banks, is that the inflation is due to a sequence of one-off exceptional shocks of one kind or another. There's a jump in energy prices, which is because of things happening in OPEC and the energy market. There's a shortage of semiconductors affecting the price and production of cars. Obviously, the ability to get timber out of forests is a given, because the forests only grow so much each year, so there's a shortage of lumber. And so on, this kind of thing. And that, of course, then being added to by the Ukraine war. Now, look, I don't dispute that supply is relevant to inflation, and it seems to me pretty clear that COVID and the Ukraine problem they have reduced the supply side capacity of the world economy in the last 2 or 3 years, perhaps by 2 or 3%, which is a rather high estimate compared with most people's. But if you're trying to explain what's happening to, say, US house prices up by 42%, then appealing to these supply-side shocks is balmy. Let's just be clear, most housing transactions are in houses that already have been built in the last few years, or sometimes decades ago. Trying to explain the current inflation episode by 1 or 2 supply-side shocks is ridiculous. The dominant explanation is the rapid growth of money, particularly in the United States, but also in other economies that we've seen since the spring of 2020 as a policy response to COVID. This policy response has basically been totally misjudged. The sequence of events essentially has been that, particularly if you think about the United States, the Federal Reserve, the economists there don't think about money. They don't think money matters at all to anything. They didn't know, they knew that there was this instrument of asset purchases to boost economies. They didn't know how to calibrate it. They didn't know how to link up a certain quantity of asset purchases to effects on the economy. So essentially, the Federal Reserve was involved through 2020 and much of 2021 in buying government bonds from non-banks, increasing the quantity of money on a much, much too large scale. Initially, that pushed up the price of stocks, pushed up the price of other assets, and houses is part of that story. And there's then knock-on effects, of course, to demand, aggregate demand. Shortages appear, and shortages are always going to be part of any inflation story. They are a symptom of inflation, not a cause of it. I'm afraid this episode has shown gross incompetence on the part of the world's leading central banks, and the root of the error has been that they don't look at the quantity of money. Now, what I'm going to do in the next few minutes is to look at the quantity of money in the world's leading economies, and then to draw some conclusions about 2023. And I'm afraid they're not very encouraging conclusions. There is going to be a recession in leading economies. The first chart is for the United States. You can see this is the growth of broad money on both the annual basis and 3-month annualized, the way I always do it. You can see that stability through the 2010s, then the fantastic surge in 2020, and now money growth coming back towards the kind of figures seen in the 2010s. And what I've done in this chart is to look more specifically at what's going on in the very recent past, just that very bit at the very end there, which I put an arrow to. The growth of bank deposits in the last 3 months, well, basically it stopped. It's only really become evident if you look at the April figures rather than the March figures, but the growth of bank deposits has stopped. In other words, the growth of money is coming down to much lower figures, the kind of figures indeed, as I said, as we saw in the 2010s, maybe a bit lower. One of the problems here is the Fed. Is the Fed going to blunder in the opposite direction? Are they going to destroy money balance on a large scale by quantitative tightening? We don't know yet, but that's to be watched out for. If so, you'll have inflation still increasing for a few quarters yet because of tightness in product and labour markets, in conjunction with very low money growth or actual falls in the quantity of money. You'll get falling real money balances, which will hit balance sheets, which will reduce asset prices, which will cause a recession, but which will then be followed by lower inflation as the price level starts to move in line after a lag with the lower rate of money growth. So we'll be seeing these processes at work in the next few quarters. I want just to give a kind of historical perspective on this. Let's look at the business cycle in the USA in the post-war period. This chart goes back to 1949. It shows the level of output relative to potential. Whether it's trend or potential, one can perhaps debate, but the idea here is that when output is at its potential level, when it's at its, what you might call its natural level, inflation is stable. And so the key to macroeconomic management is to keep output at that zero so-called output gap when you've already got inflation down to very low levels, or ideally price stability, and then if the economy stays there, you have price stability into the medium and long term, and the job of macroeconomic management has been done perfectly. You can see, in fact, that the oscillations around the zero line been less in the last 30, 40 years than in the previous 30, 40 years, but there still are these oscillations. The fluctuations of output around the trend are because of changing growth rates or changing rates of contraction of output sometimes. And this chart shows you the change in the output gap in the last 2 years. So if we think about, say, the figure for 1983, well, it's -6, that means that if the trend growth rate of the economy was 2% a year, there should have been 4% growth in that period. In fact, there was a contraction of output of 2%, so output relative to trend changed by 6%, and that's why there's a 6% value there. Now you can see that looking at this chart, the typical bad recession is indeed of output falling between, say, 4% and 8%, relative to the output gap, change in output, the output gap being between -4 and -6%. And I think that's the right kind of magnitude to have in mind for what's coming up in the next 18 months, 2 years. Now, that would translate, roughly speaking, into a fall between the last positive quarter and the final negative quarter of, say, about 4% in output. And I would then, for the year 2023, I'd be using -2% as the number for US output. This is very broad brush. All I would say is that if you see the consensus forecast being +2 or +1.5 or +2.25, it's rubbish. Just as the forecast produced in spring of 2020 by the mainstream forecasters were rubbish. To get inflation down, there has to be a period when output is beneath its trend level. It is clear at the moment from business surveys that currently output is way above its trend level. There has to be a recession to bring US inflation down. The behavior of real money is indicating a balance sheet strain coming up in the next few quarters. These things have been seen in past cycles on many occasions. Now, this picture is the Eurozone. The Eurozone policy has been in many ways of the same kind as in the USA. The ECB likes to fantasize that it hasn't got the same kind of problems as the Federal Reserve. It does have the same kind of problems, possibly not of the same severity. But again, I would suggest that we should be expecting a recession. The trend rate of growth of output in the Eurozone is very low now, largely because of demographic factors. For example, in Germany, the population of working age is falling by about 1% a year through the 2020s. And with moderate productivity growth, that implies the trend growth of output is very, very low, 0.5% a year kind of touch at most. So that a recession really means a fall in output of 1 or 2%. It may not be as severe as the United States, but there still will be a recession. Having said all that, you might say that's pretty grim. And by the way, the UK also tags that on at the end of Europe. Very similar kind of problems, very similar sorts of issues. And to give the Bank of England its due, it's been relatively upfront in its latest assessment, having been totally wrong for most of the last 2 years. Obviously, so you've got then, in, if you like, the traditional West, you've got a pretty bleak outlook. And this is very much the result, it's the kind of the obverse of what we saw, the opposite of what we saw in 2020. 2020 was too much money growth, surge in asset prices, strong demand despite COVID, and then, as we're seeing, we've got the opposite kind of problems coming up in the next 18 months to 2 years. But the West isn't the whole of the world. We need to think about Asia too, and of course there are other continents as well, the rest if you wish. And let's just focus now on China, Japan and India. Japan, in a sense, is part of the West, and you can see that they too had this blip upwards in money growth in spring of 2020. But it was much milder than in much smaller, and the rate of money growth in Japan never went above 7-8% on an annual basis. There were 1 or 2 months when the annualized rate of growth was higher than that, but the annual figure didn't go through 10%. And I think that there will be some inflation in Japan. That probably will finally, the Bank of Japan will exceed its 2% inflation target. But it's not going to be anything like as bad as in the USA or Europe. And that's despite the fact that the yen has been rather weak on foreign exchange markets in the last few months. What about China? Well, consumer inflation has been held back there partly by special factors. They had problems with disease in the pigs and things a couple of years ago, and that's come to an end, and that's then dampened down the price of pork and food. But if you, even allowing for that, they don't have the same kind of inflation problems as in the America or Europe. And so the current direction of policy is towards easing policy. And you can see this a bit in that edging up of money towards the end of the chart I've just showing you here. What about India? Well, India, there has been a slowdown in money growth recently. India is a relatively closed economy. It doesn't have anything like the trade values of China, although it's got a similar population. But I would just mention that there is some slowdown in money growth there. I think the right conclusion to draw from all this is that in 2023 there are going to be recessions in the main Western economies to deal with the inflation that is obviously very clear at the moment and is causing so much anguish. But for the world as a whole, there will probably be continued growth, not rapid growth, perhaps growth of about 0.5 to 1%. One of the problems here is to know, will commodity prices, very important subject, will they come down? Most of these downturns, most of these global downturns and slowdowns are associated with commodity price weakness. The trouble at the moment is to think of how can the oil price come down? Well, that probably will come down in the end. Most of these cycles, you always have some special supply side factor to think about, and then things sort themselves out, and so life returns to normal. I would just say one final thing, that the recession that's coming up will reflect, to a large extent, the tightening of monetary policy and the falls in money growth, movements to contractions in real money balances that are very characteristic of these cycles. But in the end, as long as money growth can be reduced to about 3-4% a year in the main economies and stabilize that kind of figure, then we can get back to the sort of stability we had in the 2010s. In fact, I think one can think about the stability of the 2010s as a kind of great stabilization after the Great Recession. And what we're going through in the last couple of 3 years is a kind of great destabilization. Let's hope the central banks learn from their mistakes and in future maintain low and stable growth of the quantity of money. Thank you.